Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Well, hello and welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks. Vance, how are you?
I'm doing well. I think we've got something for our audience today, and I'm really anxious to get into it.
Yeah, me too. We've been talking for a number of episodes about the family bank and how to create a family bank that sustains every other type of economic collapse, every other type of financial failures. How do you create a 100-year family bank? We've been talking about that. And today we're going to dig down further into the history and the science of the family bank and why there is no better method to preserve and grow your wealth.
Yeah, so maybe we begin with kind of the structure, maybe a little bit of foundation here. Our country became extremely strong. We came from nothing to the most powerful nation on the planet. And we were lucky enough, I guess, in the beginning to know how to survive. And that was taught on a family basis. And then in the schools, all the way up through as high education as you could get. And all this was accomplished before banks really entered into being, actually. So let's talk about maybe the first thing that had to be put together in order to provide the banking equation, so to speak. I think the first insurance carrier that came in was Lloyd's of London. They may have a claim to be as old as the world. I don't know, but that's the first organized insurance carrier. They mainly did for shipment and boats and things like that. But anyway, let's talk about the early participating mutual whole life insurance company. Seth, what is that structure and why is that important?
Well, you kind of touched on it. It's actually an ancient structure for centuries and centuries before centralized banking was ever conceptualized. And the life insurance products have been the most stable financial institution in the world for centuries. So the mutual companies, you're an owner, you have an ownership interest. And so there's dividends paid to owners. And those owners are treated differently than if you were a stockholder, if you were, a shareholder, so to speak, that has little or no voice. I think that the mutual life insurance companies have created that niche there that is unsurpassed in every other financial tool. And you go, what about the Civil War? That was the banking methodology at that time and era. You had life insurance contracts, but they didn't fail. Life insurance companies didn't implode during the Civil War. They maintained course. But what about the Great Depression? Same thing. So I'll let you comment on that. But I mean, we're talking about the stability during any type of economic downturn or recession, how that allows you to have security and safety and long-term planning and distributions. You've got a guaranteed contract growth with your mutual life insurance companies that we use. And so those are just a number of the features and the benefits. I mean, but I'll let you comment on what I said.
I can envision at the beginning, is at the startup of these companies, a group of citizens, so to speak. Some had a little bit of money, but others, they had the need, banded together and formed these co-ops. I think they were co-ops in the beginning, and formed these mutual companies for the benefit of each other. And then once the company and the structure was formed, they would go out and share that with their families and friends, and all wanted to be part of it. They wanted the structure to be pure, very efficient, and very profitable. Now, over the years, that profitability, we could say, kind of gets eroded a little bit, because of just the modern day era. But like Seth, you said, these were put together in such a safe structure that they could withstand anything. At least they thought they could. And so far to date, they have. All the economic downturns that the world has thrown, and all the bank failures and the depressions and failures of large corporations has not affected these mutual companies. The benefits that you're touching on, the stability, the long-term planning, folks, what we need to understand is that when we enter a contract here, we can know exactly minimum what we're going to have 5, 10, 15, 20 years from now in those accounts as far as the growth buildup. In addition, what we call the dividends or the profits of the insurance company, if it runs efficient enough, then there are profits to be had, and that is shared among all the policyholders. And that is something that goes directly into their accounts on a what's called yield basis that can never be reversed. All credited money into these accounts can never be reversed. And that's the total opposite of other type of investing. The stock market, mutual funds, anything like that. They all do things on, and we've described this in earlier podcasts, on average rate of return. And though the math is correct, the amount of money that people receive is nowhere close to that. So that's the structure, and that structure has proven itself over and over again. And I think that's why we fast forward today. We've got the banks out there, everything else. There's a lot of reasons to get this back into people's lives, to understand how these contracts work, because if they'll take a good look and they understand things, then they'll use this as one of their choices. Everybody considers banks as the epitome of money management and the understanding of how to grow money. Well, our banks use these. These are the very contracts. So let's talk about maybe life insurance as a good asset class. Let's kind of get into that a little bit.
Yeah, I think it's like we talked about, it's one of the oldest financial tools in the modern world. And we're not solving necessarily for the death benefit. We've got something that evolved into a much more powerful tool. It acts as a store of capital, and you're actually able to earn 6 to 7% currently year over year, compounding. So it far outperforms storing your money in centralized banks for that reason alone. But there are numerous other reasons why centralized banks aren't a safe place to store large cash value, which we talk about consistently. But their life insurance contracts, in addition to being a savings vehicle, it acts as a capital reservoir that's protected by many states, legislative governance of life insurance contracts. It's a state regulated issue, not federally. And so each state has its own law on life insurance contracts, and many, especially southern states, have laws on the books where your life insurance contract cash values, distributions are completely protected by law. And then we talked about how it compounds. And if you don't know how the value of compounding growth, tell them the story about a penny compounded. We talk about that, but it bears quick repetition, Vance. What a penny compounded over 30 days.
Einstein said the eighth wonder of the world was compounding, and you have to keep it in play and you have to keep it working for you. And this is where people go wrong when it comes to compounding. If they're not in control, the compounding doesn't work in their benefit, it works in someone else's. They get the crumbs, and those crumbs can compound, but they never do get to see the real results.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue, but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
So if I go back to this structure, once we set the structure up correctly, and again, we can point back to a podcast, it becomes the perfect investment. It creates so many avenues for a person to be able to accumulate, compound, or whatever they need. This becomes literally the in-depth and epitome of investing because of what it provides with absolutely no risk. The only possible risk to this contract is you. Let me give you some examples here of what maybe this thing can do just on a layman's term, functionality of a family. It's a great place to save money because it's liquid. Once you get it going, you have access to that money pretty much anytime you want. We usually suggest a little bit of structure there because they aren't quite like the way banks are, but it's your money. That the cash value portion of it, we design banking contracts to develop the most cash possible. We want to get them over 100% efficiency, which means producing more than what you put in every year as soon as possible. So we got the savings vehicle. We can set up our own lending structure, usually cars, education, whatever is needed. We have these accounts. You can drain the account or you can borrow it and pay yourself back, just like a normal structure. If you do that, everything grows and compounds. If you save up and spend, you're no better off than you always have been, because once you take money out and you spend it, you lose control of that money. These vehicles let you use money and put it back and use it over and over again and collect compounding interest. There's all kinds of benefits in here. When there's enough money working for you, there can be a wonderful lifestyle change later on where the dividends, the earnings are producing the income you need at an older stage in life than any other type of government ERISA program. Which are controlled by government. So these are private and independent. They're liquid. They're one of the biggest advantages of this type of structure. They're not reported to the IRS. There's no tax disadvantage. They're all tax advantage because if you do things right, not only having the other advantage I've just explained is that there's totally tax advantage for you and continue to tax on. And here's something, it'll pass on to heirs when you're done with it if you do it right. Seth, I think
The tax carve out is pursuant to Internal Revenue Code 7702, which makes your distributions tax-free. And so that's by like you said, if it's structured properly and we don't mech the policy. A modified endowment contract is in some situations okay, but we usually want to stay within that tax-free economy. So let me ask you this. Why would you put your money in a typical large bank or even maybe, regular bank that's in your city that's governed by FDIC insurance rules, and they promise to have your cash there when you want it, and it's convenient, and it hasn't failed yet, at least not the Wells Fargo or Bank of America? Why shouldn't I keep my money there instead of a life insurance contract? What's the reason?
I've kind of dedicated my remaining time to help educate the people I care about of what money really is and how it works. You owe it to yourselves to learn, folks. You can't rely on what government is saying or the banks are saying or anyone else is actually saying and take that as face value. You have to understand how money works, how it grows, how to preserve it, because if you don't, you are subject to someone who does. You pass that independence to bondage, in essence, because you don't understand the workings of money. And I think we could all take this test on what I'm talking about. If we have to go to work to earn a dollar, usually that spread between what your efforts are in producing money for your company can be anywhere from 5 to 50 to 1. You're getting the one, the corporation and everybody in between can get up to 25. So every dollar you get by the time you get through paying Uncle Sam and everything else. So we have to work hard. We have to spend our time, our clothes, our talent, the wear and tear a lot of times on our equipment to be able to bring home a paycheck. So what do we do with that? If we don't understand how money works, we spend it. And it forces us to go back to work and do the whole thing over again, over and over and over again. There's a few simple things that a lot of you probably know about, but you've decided not to do because your friends aren't doing it, no one else is doing it, your mentors aren't doing it. They all think they know something about how money works, but we really don't. And we become actual slaves to the system, and we don't even know that. How'd you like to have some more independence? If you can learn some of these simple things that we teach, every single month you're going to be better off. You're going to put more money to work producing money for you every month. So what we're trying to put in here and what we're trying to do a deep dive on and actually describe for everybody is how important this structure is. And I believe that this is a structure that's just, I'm going to call it divine, because it works so well. Learn it, capitalize on it. One of the best structures, if you don't believe what we're saying, find out where the banks put their money. Seth, tell us about that.
Yeah, we've talked about this, that the large top tier banks have a healthy portfolio of life insurance contracts on employees, and they generally use it as an incentive, and they will give the employee a certain benefit, a certain death benefit, but they also have use of the cash. They have the accumulation, the compounding growth, the tax-free economy. And so they bank a lot of those annual dollars, 20 billion a year with the top tier banks in life insurance premiums. And they disclose those things in their financial disclosures on an annual basis, so you can look those details up. It's a great tool and a roadmap, but the rest of the banking, and kind of answer my own question, one of the reasons we don't believe that keeping large stores of cash value in centralized banks is because of derivative lending. And every dollar that we take in, 90 cents is taken out the back door and lent, and they don't share those profits with us when we're their capital partner. We're giving them capital to go loan, and they don't make us a capital partner. They actually charge us fees and give us hassles, and it's just ridiculous. Where the life insurance companies, your money is going to grow and compound year after year. And what I want to talk about in our next episode, Vance, is the predictability of compounding growth and how those who don't earn it pay it. That's a great tool for us to learn and understand, but I think we'll wrap this episode up here and lay a teaser for next week's episode regarding the how-tos of compounding growth.
Let's do that, because I'm hoping we're whetting your appetite just a little bit. We want to get into this a little bit deeper. Each time we do one of these podcasts, we try to take a little bit different angle so people can hear it a little bit different way, so that some lights will click for you. What we have is gold. What we have is a in-depth desire to help everybody be better off. And just ending with what Seth said, those who understand compounded growth make it, and those who don't pay it. Which are you?
That's right. Folks, if this content's resonating with you, hit our website. It's privatebankingstrategies.com. There you'll find a free gift invitation. It's a book that Vance and I authored that tell you secrets about bank strategies. We give you roadmaps within that book that will lead you to a conclusion of how to implement financial freedom. So put in your email, your name, and in return for that, we'll give you a PDF version of this book or an audio version you can listen to on the go. But more importantly, we're going to send you an email once a week that announces our podcast and gives you a link to Vance's calendar. And that's the only place you're going to find it. So if you would like to learn more about private banking strategies, how to create a 100-year family bank, how to capture compounding growth rather than pay it, then go to our website and follow those steps, folks. Until next time, we'll see you.
We'll see you. Thank you very much.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies Podcast. Click the subscribe button below to be notified when new episodes become available.